What if I told you the absolute hottest aerospace stock of 2026 might actually be a ticking time bomb, or, hear me out, the greatest turnaround play of the entire decade? Seriously, stop what you're doing. If you own Astronics, ticker symbol ATRO, you need to hear this 5-model valuation breakdown before the market even opens tomorrow. Because last week, I ran ATRO through 5 rigorous valuation models and 2 legendary investor checklists. And what I found? It completely shocked me. Look, I know exactly how terrifying it is for retail investors out there right now. You see a stock hitting record highs, you jump in purely out of FOMO, and then, bam, the bottom completely falls out, just because you didn't check under the financial hood. So, let's look at the actual numbers here. Astronics has skyrocketed over 163% in just the last 52 weeks, trading right around $84 a share. But here is the crazy part. Despite record Q1 bookings of $290 million and a massive $734 million backlog, these intrinsic value models suggest a potential 22% downside from its current price. Which begs the question, are you paying a premium for growth that's already completely priced in, or is this just the very beginning of a massive multi-year breakout? Think of Astronics kind of like a high-performance jet engine. It's incredibly powerful when it's firing on all cylinders, right? But if just one internal gear slips, the whole thing crashes. By the end of this explainer, you'll know exactly if ATRO is a Warren Buffett buy or a classic Peter Lynch value trap. And I promise you'll walk away with a clear, actionable framework you can literally steal to analyze any stock in your own portfolio. We're stripping away all that Wall Street noise today and just looking at the raw data. So let's dive in. Part 1, aerospace growth versus financial risks. Okay, so let's get right into the qualitative story here. The absolute momentum this company is riding in the aerospace sector. Because frankly, you just can't understand a stock's price without understanding the narrative driving it. Take a look at this specific win. Astronics was selected by Bell Textron to develop the electrical power distribution system for the U.S. Army's MV-75 program. Now, this isn't just some minor run-of-the-mill contract. This aircraft is meant to replace up to 2,000 Black Hawk helicopters across a massive $70 billion program lifespan. And for every single one of those new aircraft that rolls off the line, Astronics has an estimated shipset content of roughly $1 million. That is a monumental long-term revenue stream they've got locked in. But wait, it's not just legacy military upgrades either. Astronics is positioning itself super aggressively in emerging flight-critical markets. We're talking drones and eVTOL, electric vertical takeoff and landing aircraft. This strategic positioning across commercial transport, military, and emerging tech, that has directly contributed to their staggering $734.3 million backlog. Honestly, it's a phenomenal business narrative. Part 2. Deep fundamental financial data. But here is exactly where we pivot, because a great story is really just a story until the math actually backs it up, right? Does the balance sheet support the hype? Well, the free cash flow data brilliantly illustrates what growth investors are cheering about right now. Back in fiscal year 2023, Astronics was bleeding a very dangerous negative $31.64 million in free cash flow. But fast forward to fiscal year 2025, and they executed a powerful $43.12 million recovery. That is a massive operational turnaround. It proves management can actually stop the bleeding and start generating real cash. So the absolutely crucial point here is weighing these two realities against each other. The bull case points directly to that flawless operational execution, a record $290.4 million Q1 booking quarter with higher volumes and better productivity. Sounds great. But the bear case? Well, the bear case is looking at the price you're actually paying for that execution. You are buying in at a trailing PE of 68.73, and you're taking on a company with a heavy 2.34 debt-to-equity ratio, so you are paying absolute top dollar for a pretty heavily indebted balance sheet. Part 3, 5-model valuation breakdown. So how do we actually find the truth between the bulls and the bears? We run the numbers. Let's start with the enterprise value to EBITDA trend. In fiscal year 2023, this multiple was a wildly unstable 39.61x. By fiscal year 2025, as those earnings recovered, the multiple finally stabilized down to 23.8x. Now don't get me wrong, that's a massive improvement, but I gotta warn you, an EV to EBITDA multiple of nearly 24 is still considered quite elevated. You are essentially paying a premium, expecting that their earnings will just continue to explode upward. And that brings us directly to the growth expectations that are currently baked into the stock. Astronics recently raised their 2026 revenue guidance to an eye-watering range of $970 million to $1 billion. To put that into perspective, their fiscal year 2025 revenue was $862.13 million. The market is pricing this stock based on the absolute certainty that they are going to hit that $1 billion mark and just keep growing at over 5% every single year. But what happens when we run those exact forecasts through multiple intrinsic value algorithms? Well, the outcome is pretty sobering. Factoring in their current debt load, required growth rates, and future cash flow projections, the models point to a fair value estimate of exactly $61.18. Remember, the stock is trading around $84 right now. That represents a potential 22% downside. The math is basically screaming at us that the stock price has outrun the company's actual fundamental value. Part 4. The checklists, Buffett and Lynch. Now, models are just one part of our framework. First, let's evaluate ATRO through the Peter Lynch turnaround lens. We all know Lynch loved companies bouncing back from the brink, but he had super strict rules. ATRO's PEG ratio, that's price to earnings to growth, sits at 1.54, which means you're still paying a bit of a premium for that growth. But the absolute biggest red flag for a Lynch turnaround, the balance sheet. Astronics is currently carrying a $379 million debt load. For Lynch, heavy debt in a turnaround is a major hurdle, mostly because it completely restricts a company's flexibility. Next up, let's run the Warren Buffett quality numbers. Buffett is always looking for phenomenal capital allocation and wide competitive moats. And here, to be fair, Astronics really shines in one specific area. They boast an exceptional return on equity of 21.18% and a return on invested capital of 19.24%. Buffett absolutely loves those kinds of returns. But, and this is a really big but, Buffett demands a margin of safety and a fortress balance sheet. ATRO has a negative net cash position of negative $367.24 million. That total lack of a safety net, that would almost certainly keep Buffett sitting on the sidelines. Part 5, the final stock verdict. Okay, we've looked at the narrative, we've crunched the math, and we've run it through the legendary checklists. Let's synthesize all this to deliver our final, completely impartial verdict. Does Astronics actually justify its premium? Here is exactly what you need to take away from this explainer. Operationally, Astronics is firing on all cylinders. They've got that record $734 million backlog, they're winning massive military contracts like the MV-75, and their free cash flow just did a beautiful 180-degree turn. But remember, as an investor, you don't just buy the company, you buy the stock. And at $84 a share, with a fair value estimate pointing to a 22% downside, you are quite literally paying for absolute perfection. So I'll leave you with this provocative question to chew on. Can Astronics' flawless operational execution and $1 billion revenue forecast actually outrun its expensive valuation, or is a correction totally inevitable? Keep checking under the hood, and I'll see you in the next explainer.